Imagine spending 6 months grinding to pass a major prop firm challenge. You finally secure your funded account, and the next morning you wake up to an email saying the firm is insolvent and your account is frozen. Traditional brokers operate under strict oversight from authorities like the FCA or ASIC. The prop firm industry is still finding its regulatory footing. Staying loyal to a single platform leaves you exposed to their internal liquidity issues or sudden rule changes. If your entire trading income relies on one company's backend provider or their specific interpretation of news trading, you do not own a business. You are a highly vulnerable independent contractor. For an amateur, a single prop firm failure is a career-ending catastrophe. For a professional who spreads their capital across multiple firms, that exact same insolvency is merely a 15% dip in their total assets under management. Surviving the volatility of the prop industry requires changing how you view your operation. It's time to stop acting like a lucky contest winner and start building the structural resilience of a boutique hedge fund manager. Building this resilient machine starts by abandoning the instinct to park all your capital in a single execution environment. Spreading your accounts mitigates your risk. A robust portfolio mixes different regulatory zones and platform types. A reliable Big 3 allocation combines a legacy EU-based CFD firm, a newer UAE high-growth CFD firm, and a US-based futures prop firm. The US futures component provides a distinct layer of structural protection. Instead of trading in the decentralized Forex market, you are executing directly on a centralized exchange like the CME, tapping into a different regulatory layer and liquidity pool. By enforcing this strict geographic and structural spread, you guarantee that a localized crackdown or broker outage cannot wipe out your entire operation. Managing 5 different accounts manually is a recipe for disaster. Constantly logging in and out of different platforms creates execution errors and leads to mental burnout. The industry standard to fix this is a master-slave trade copier architecture. You execute on one main account, and the software instantly mirrors the trades to the rest, all hosted 24/7 on a high-spec virtual private server with dedicated IPs. Warning tone. But this creates a hidden compliance trap. Prop firms use sophisticated software to detect identical execution timestamps. If 5 accounts hit the exact same trade to the millisecond, the firm flags it as prohibited group trading, and you will be banned. To navigate this, professional copiers allow you to inject an algorithmic jitter. By adding a randomized 1 to 2 second delay between executions, you ensure every single account has a completely unique trade signature. Properly configuring this automated architecture turns a logistical nightmare into a secure, fully compliant execution engine. Once the technology is set, you have to recalibrate your risk profile. While an amateur risks 1% per trade, a professional managing multiple accounts lowers their per-trade risk to 0.25 or 0.5%. If you don't lower your risk, you fall into the aggregate drawdown trap. Copying a 1% risk across 5 accounts means a tiny 3-trade losing streak could breach the combined daily loss limit of your entire career portfolio in a single afternoon. This risk compounds if you ignore market correlation. Taking simultaneous setups on gold and Euro USD doubles your exposure to underlying US dollar volatility. If the dollar spikes, you hit 10 stop losses across 5 accounts in one single move. You have to remember you are trading the buffer, not the headline number. 5 $100,000 accounts with a 4% daily limit means your real trading capital is only a $20,000 environment. Protecting that buffer requires a master kill switch, closing all active trades across all platforms the moment aggregate losses hit a strict 2% threshold. The defining trait of an asset manager is managing these collective defensive limits. The ultimate priority is always protecting the portfolio's overall health, rather than maximizing the offensive gains of any single isolated account. When it comes to funding these accounts, buying a massive $300,000 challenge with your own savings is an error. Start the seed phase using a small amount of personal capital to pass a low-stakes micro-challenge. Once you secure your first payout from that micro account, you enter the extraction phase. You route those profits directly into purchasing the larger institutional-grade accounts required to effectively build out your Big 3 portfolio. We call this capital recycling. When you are playing entirely with house money and your personal risk is down to absolute zero, the fear of loss disappears. You finally stop trading your anxiety and start executing pure strategy. A one-off payout screenshot provides a quick dopamine hit, but private investors look right past it. If you ever want to manage private capital, you need third-party audited metrics that calculate your risk-adjusted returns, like your Sharpe ratio and maximum drawdown. Top-tier global financial authorities, like the Bank for International Settlements, prioritize long-term consistency and capital preservation over raw percentage gains. This chart showing your aggregate equity curve, verified on a platform like Myfxbook, is your professional resume. A chaotic graph with massive spikes and deep valleys signals a gambler who got lucky. A professional's curve shows a smooth, steadily climbing 45-degree angle with minimal drawdowns. When you are managing a $2 million prop portfolio, a 1% gain is $20,000. The goal shifts entirely away from hitting home runs. Your only job is to simply stay in the game. True professionals structure their environment so failure is mathematically constrained. To start operating like an asset manager, download the Prop Portfolio Risk Calculator and join the FXNX Discord to see our top traders manage multi-firm logistics in real time. And when you're ready for institutional-grade execution, open an NX1 account today.